Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we're doing a deep dive that's really built for you, the learner. Someone who wants to get that strong financial foundation, but, without getting lost in all the complexity. We're going to be targeting two really fundamental misconceptions for beginners. And if you don't check them, they can seriously compromise your long-term stability, maybe even your happiness in retirement. First up, we're tackling that myth that high-dividend stocks are somehow guaranteed safe money. And second, we're going to realign the role of investment itself. We want to move it from being this central focus of your life, the thing you hope will let you hit it big and quit, to its proper, more powerful role as a support system.
That's absolutely critical. I mean, recent analysis shows that a lot of new investors, they really do prioritize those immediate visible payouts.
Like dividends.
Yeah, exactly, like dividends. Or they start chasing these high-risk, quick-gain scenarios. And these approaches, well, they often blind them to the structural realities of managing your money for the long haul. So our mission today is to shift your perspective, move away from that short-term yield chasing and toward, strategic long-term stability that's built to maximize your quality of life decades from now.
Okay, let's unpack this then, starting with one of the most comforting and maybe one of the most misleading ideas out there, the dividend myth. The story is just so compelling, right? You buy a stock, and then like magic, it pays you cash every quarter. And you never even have to sell the asset itself. So a lot of beginners, they look at high-yield dividend stocks as this ultimate safe asset, something that feels like a savings account or a guaranteed deposit that's going to reliably fund their retirement.
It sounds perfect. It really does. But that comfort, it's often misplaced. And it can lead to some pretty big structural errors in a financial plan. What's fascinating here is how the core misunderstanding really centers on the difference between, well, the nature of a dividend and the nature of true fixed income.
Okay, so can we break that down? What is the tangible, real-world difference for the listener between getting a dividend check and, say, getting interest from their bank?
The whole thing boils down to predictability, and predictability is just. It's key for retirement planning.
Predictability.
Right. When we look at the sources, we see that dividends are fundamentally variable income. They're not fixed. There's no contract guaranteeing them like there is with bank interest or a coupon payment on a bond. Think of it this way. Your bond interest, that's like a guaranteed contractual salary. The company is legally on the hook to pay you, or they go into default. A dividend, though, a dividend is a distribution of profit. And it's entirely up to the company. It's discretionary. It's much more like a corporate bonus.
And bonuses can get cut.
Precisely. If the company's performance dips, or if the management decides, hey, we need to reinvest this capital, they can reduce or just eliminate the dividend immediately. We saw this happen across the board during the 2008 crisis. But even smaller downturns can trigger cuts. And what that means is a retiree who's relying only on those payments, well, they're linking their quality of life directly to the very volatile stock market.
Which creates massive uncertainty, the exact thing you're trying to avoid in retirement.
The very thing. It's the opposite of what you want.
Okay, so if the dividend stream isn't reliable, that brings us to the more robust way to fund retirement, which is total return.
Yeah.
But I think a lot of beginners, especially the ones who follow this dividend-only mantra, they really misunderstand what total return actually means.
Oh, they do. And this ties directly into the second big problem, this psychological trap of never touch the principal.
The sacred money.
The sacred money, exactly. The dividend-only strategy reinforces this idea that the principal asset, the stock's value, is untouchable. It's this reserve you have to protect no matter what. But total return, it's actually much simpler. It's just the sum of all the returns you get from an investment. That's both the dividends or interest plus the capital appreciation.
The growth in the stock's price.
The growth. And if you only live off the dividend, you are often ignoring the most powerful part of your investment engine, which is that growth.
But wait a minute. Doesn't selling the principal expose you to the risk of running out of money? I mean, isn't that exactly what people are trying to avoid in the first place? How do you even quantify that risk?
That's the critical question. And this is where good strategic planning really triumphs over fear. By refusing to touch that principal, the investor often ends up with incredibly inefficient asset utilization. They end up living, really frugally, constantly worried about preserving that sacred principle, only to leave these massive untouched sums of money behind when they pass away.
So there are strategies for this.
There are. We have established retirement withdrawal strategies. The most famous one is probably the 4% rule.
Yeah.
It's based on decades of data, and it suggests that withdrawing 4% of your total portfolio value in your first year of retirement and then adjusting that amount for inflation each year after has a very high probability of lasting 30 years or more.
Even with market volatility.
Even accounting for market volatility, yes.
So instead of being stuck with whatever the dividend happens to be, maybe that's only 2%, you plan to strategically use the total asset. You could potentially take out a safer but larger 4% amount, even if that means selling a few shares every year.
Exactly. I mean, unless your specific goal is to leave a large inheritance, the purpose of your money is to maximize your quality of life while you are alive. A total return strategy, one that includes spending down some of that principal over time, is very often the more rational choice for truly getting the most out of those retirement decades, rather than just, living in fear of selling a share.
And this is where it gets really important for the long haul.
Yeah.
Because even if your dividend stock does manage to maintain its payout, we still have to talk about the silent killer of retirement income, inflation.
That's the third structural flaw. The data shows that while a lot of high dividend stocks pay out cash now, they often represent mature companies that are basically trading future capital growth for that current yield. They just aren't designed to grow all that rapidly. So over a long retirement, your living costs are steadily rising because of inflation. But the dividend payments from many of these stocks, they just fail to keep pace. The underlying asset isn't growing fast enough to boost the payout.
Let's make that real for a second. Let's say you retire with a stock that pays a $4 annual dividend. If inflation is running at, say, 3% a year, in just 10 years, that $4 dividend now has the purchasing power of what about $3 would buy you today.
And that's the core of the problem. Your nominal payment might stay at $4, but your real spending power is eroding.
So you feel poorer every year.
You are poorer every year. That initial dividend income that felt totally adequate slowly loses its real purchasing power. And that leads to a diminished standard of living over time because your main source of income, the dividend, it just doesn't have the growth needed to fight off inflation.
So what's the actionable takeaway here for a beginner? It sounds like we need to worry less about the specific dollar amount of the annual dividend and a lot more about whether that dividend, combined with the stock's growth, can maintain the same quality of life 10 or 20 years from now.
The key insight is this. Dividend stocks aren't useless. They serve a purpose, mainly as a supplementary cash flow stream inside a diverse portfolio. They work well when your main living costs are already covered by other more reliable assets like bonds or pensions, but you have to see them as part of a strategy, not the whole strategy. The goal is lifelong stability and satisfaction, and that is best achieved through a total return approach that views all the components, dividends, capital gains, and a planned principal drawdown, as one unified resource.
That distinction, seeing your investments as one unified pool of resources versus this segregated machine of principal and yield, that's so crucial. Okay, now that we've talked about how assets should be used, let's shift gears to how they should be generated in the first place. This brings us to our second deep dive, the proper role of investment in your life. The second big misconception we see is this idea that investing has to be the central driving force in your life, this sort of obsessive, all-consuming goal of hitting it big and quitting the job as fast as you can.
And that expectation, it just sets people up for failure and a lot of disappointment.
Yeah.
The data shows that expecting your investment returns to radically change your life overnight, that's a path reserved for an infinitesimally small minority. For almost everyone, investment is a necessary tool, yes, but it is fundamentally a secondary one. And the first, most foundational point here is that stable work is the primary source of wealth accumulation. The steady compounding of a stable income, your career growth, acquiring marketable skills and experience, that is the main engine of your economic foundation.
So why do we emphasize the job or the career so much when we're talking about investing?
It's about control and scale. Investment, by its very nature, is, well, it's uncertain and you can't control it. You have no control over what the S&P 500 is going to do tomorrow or next year, but you can largely control your effort, your skill development, your networking, your career path. And what's more, when you're young, the returns you get from improving your career, like a 10% raise from getting a new job, that absolutely dwarfs the returns you might get from a small portfolio, even in a great market year.
Right.
So the warning here is pretty clear. The moment you start expecting your investments to substitute for the fundamental act of working and growing your skills, you become highly likely to take excessive, imprudent risks.
Chasing that dream.
Chasing that quit-the-job dream.
Yeah.
You start treating the market like a lottery ticket, not like a compounding machine.
This raises a really important question then. If work is the main engine, And we can't rely on our investments to make us rich overnight. What is the core purpose of investing in the first place? If it's not offense, is it purely defense?
It is fundamentally defense. The main purpose of investment is protecting your purchasing power. Investing is absolutely essential, but its core job is to preserve the value of the money you earned through your labor. I mean, think about this simple reality. You work diligently for a year and you save, say, $10,000. If you just leave that money in a standard low-interest savings account, inflation is this silent, constantly rising cost. If inflation is 3% this year, then next year, your $10,000 can only buy what $9,700 could buy the year before. The result of your hard work is literally eroding every single day.
So you're saying if you just save money, you are guaranteed to lose purchasing power over time.
Precisely. You are guaranteed to lose. Investing is the tool that defends against that loss. It's the mechanism that makes sure the money you earn today will still be able to pay for future expenses, whether that's a down payment in 5 years or your retirement in 30. It safely carries the results of your labor into the future by making sure your money grows at least as fast as the cost of living. And that's a fundamentally healthy defensive mindset.
That really reframes the whole interaction, doesn't it? It stops being this sort of gambling mechanism and it starts being a financial tool. Which brings us to the healthy structure for building wealth. What is that proper relationship?
We call this point 3. Life leads, investment follows.
Life leads, investment follows.
Exactly. Work is the process that drives your life forward. It expands your opportunities. It helps you set goals. As your skills advance and your income grows, your goals naturally expand. You might aim for a better neighborhood, or plan for your kids' education, or just aspire to a more comfortable retirement. The role of investment is not to dictate those life choices. It's not to pull your life along. Its role is to financially support the expanded goals that are set by your career and your personal development. The structure should always be, you advance your life and career first, and then your investment strategy aligns itself to follow and stabilize that path.
So if my life goal is to buy a house in 5 years, my investment strategy adjusts. It becomes lower risk, more liquid to meet that timeline. But if my goal is retirement in 30 years, the strategy shifts to higher growth, longer-term risk tolerance. The investment strategy is basically reactive to the life plan.
And that's the psychological benefit of keeping investments secondary. By decoupling your sense of self-worth from the market's day-to-day performance, you gain this massive psychological resilience. When returns are poor, and they will be, sometimes, you don't feel like your entire life is a failure. Your focus stays on your main sources of stability and growth. Your job, your career, your human capital.
So the ultimate insight here is replacing that goal of making a fortune to quit working with a much more sustainable mindset, something like working diligently to advance my life and using investment to protect and expand the money I earn, leading to a better life. This transforms investment from a high-stakes, short-term game into a crucial, stable, lifelong skill. And that wraps up our 2 deep dives for today. Let's just quickly summarize the essential mind shifts we covered for you, the learner.
Okay, first, when you're looking at potential retirement assets, you need to recognize that high dividends, while they offer psychological comfort, are variable income streams. They're vulnerable to inflation, and you risk inefficient asset use if you refuse to touch the principal. You have to focus on total return, the combined growth and yield, and plan for strategic principal use.
And second, work is the foundation of your wealth. Investment's primary job is defensive, to protect the purchasing power of that money and to support the life goals you set through your career. Never mistake the tool for the main engine.
And we've established that the asset accumulation phase, your working years, is just structurally different from the asset utilization phase, which is retirement. One really crucial piece of synthesis from the data is the need to overcome the fear of spending. In retirement, the fundamental shift moves from protecting the principal at all costs to strategically understanding how to use your total asset base to maximize your quality of life in your later years.
Which means we all have to reevaluate what money's really for. If the ultimate purpose of the wealth you're building is to maximize your life satisfaction, and not just to be left unspent, what concrete steps can you take today to shift your financial focus from simply accumulating yield to planning for strategic, intentional spending later on? That's the question that really dictates how well you'll live in retirement. Thank you for joining us for this deep dive into investment insights. We hope we've given you the knowledge to look at your financial life with a healthier, more sustainable perspective. Don't forget to subscribe and hit that like button.